Hi, I'm Amanda Morrell with interest.co.nz, and I'm here today with a double shot interview with Martin Hawes. He's a financial writer, a columnist, a financial advisor. And Martin's here today to talk to us about his latest book, The Money Map. And this is book number 20, I believe, for you, is it, Martin?
Yes, it is, Amanda.
Yeah.
Yes.
Wow, congratulations. It's quite a prolific repertoire.
It's over a long period of time. It's over 20-something years now.
Right. Yeah. So tell me about The Money Map. How does this differ from some of the past investment books that you've written in the past?
Yeah, what I was trying to do was to give a structure for a financial plan, for wealth planning, for trying to say, where are you at the moment? Where do you want to be at some point in the future? And how do you bridge the gap between one and the other? And that's the bare bones, if you like, the skeleton of a financial plan. You've got to put a lot of flesh on it and a lot of sinews and a lot of other bits and pieces. But the basic process is to say, this is where I am, that's where I want to be. And then to draw a map, to draw a line, to draw a route between where you are now and where you want to be at some point in the future.
And so who is this book geared towards? Who's your audience?
It's the general public. It's anybody who's interested in money. You know, I get a lot of people who say, I can't do this financial planning stuff. To which my answer is, well, can you read? Yeah, most people, can you add and subtract? And that's about all the skills you really need. Actually, the thing that I think holds people back is between the ears. It's attitude. It's whether you have the discipline to do this stuff. And I suppose whether you have the aptitude, whether you want to do it, is more important than what you know.
You're obviously in the financial advisory business, but to what extent do you think people can sort of self-direct their own destiny, their financial destiny?
Well, I think to a very large extent, if they want to. My worry is that people will fall sometimes between the two stools. There's one of being self-direct and another simply handing your money over to a financial advisor and let them take care of everything. The difficulty arises with just about all things really in business and finance is messing in the middle. So I think you've either got to decide, I'm going to yes, take some advice, I'm going to read a lot, I'm going to listen a lot, but I'm going to self-direct and take charge of my own finances, or go to the other end of the spectrum, which is giving your money to a professional. My practice, the wealth planning that I do, has always really, and I've been doing this for 20 odd years, it's always been about helping people to self-direct. Yes, I would suggest managed funds to people, but they will be a certain kind of managed fund generally. But largely I'm helping people to, and advising people in directing, managing their money themselves.
Okay. What are some of the most common mistakes you come across with people?
Oh,
I'm sure there's many.
There are many sort of potholes in the road. I think tips from the brother-in-law or financial advice from the kindly uncle would be right up there. That would be a major one. When you get onto technical stuff, people investing before they've paid off their mortgage. Generally, there are exceptions, but generally you should be paying off the mortgage before you start to invest.
Okay.
I think going off into the wrong areas of investment, and that, the obvious one was the finance companies, but I mean, I thought at the time that was writ large, that it was a disaster waiting to happen. New Zealand had all these very small, under-regulated banks, and that's what a finance company basically was. I thought that was a disaster waiting to happen. My worry is that residential property as an investment could be the next disaster waiting to happen. We've had 3 or 4 years of very flat returns there, and it could be that continues for a fair while yet.
Interesting. We have quite an aggressive property audience on our website. They love property.
Yeah.
And they will challenge you on the notion that property does poorer than stock markets, particularly over the last few years. What would you caution them about?
First of all, you've got to decide what sort of time period you are measuring it against. And with both shares and with property, you should measure it over very long periods of time. And probably over very long periods of time, the returns from shares and property are fairly comparable. Okay. I think shares, under most measures, probably beats property, but only by a very small amount. Mm-hmm. However, that's always interesting to look back into history at how well things have done. When you look at conditions as they are now and you try to extrapolate into the future, what you can say when you look at residential property is that it is very low yielding. The yields are so low that to purchase a rental property is not really investment at all, because the yields are so low. You are really speculating. Your investment can only stand up if prices rise. Now that's speculation, just like gold speculation or buying oil futures or anything like that is speculating, because there is no income there. Ben Graham, mentor of Warren Buffett and professor of finance at Columbia University, he talked a lot about speculation versus investment, and an investor looks first of all at income, and capital gains a bit of a bonus, whereas a speculator simply doesn't care about income, just looks as wanting to see price changes one way or the other. Okay. And residential property at the moment, the yields are so low that you're really only speculating.
So what signs would you be looking for in a residential property market that is worth your while?
Well, for me, to invest my money in residential property, I would need a really well located property, rented to very good tenants, or the types of people who are very good tenants, and I would want to get a net yield of about 7%. Okay. Otherwise, I simply, I'd say, well, why bother? I can buy listed property trusts. I can buy Goodman Property Trust, or I can buy AMP Office Trust and those sort of things, and get a better yield than that. Why would I bother owning a single asset and having all the management difficulties? Now, where can you get a well-located residential property leased to a really good style of tenants and get 7%? I doubt you can. So what's an intelligent response to that? It's to sit on your hands. It's to do nothing. It's to keep out of it. And that would be my advice to people with residential property investments at the moment. Okay.
You're forecasting maybe some uncertainty and some tough times ahead.
Yes.
Or, what, 3 years, 4 years? When do you think we're going to be in the clear?
Well, I don't have a crystal ball. So you can't say precisely. What you can say is that there are a lot of economic imbalances in the world, that we've got part of the world exporting madly and saving madly, and the other part importing madly and borrowing a great deal. There's a huge amount of debt and indebtedness in the world, and I think the great financial crisis is likely to continue in a more subdued way, but the difficulties which created the great financial crisis are going to run on, I think, for 3 years, perhaps, maybe 5 years. I'm very optimistic in the long term. I think if you look out 10 years, I think human beings won't stop inventing things, business won't stop making money and so forth. So I'm very optimistic in the long term. But I think that the next 3 to 5 years, I think those years are still going to be fraught, and very dangerous.
Okay. So maybe in the short term, a good idea to just sit back, study up,
well,
figure out your plan.
My own investment strategy has largely been to hold cash. We cashed up in 2007 because we thought that There was a consumer binge going on, and I was reading a fair bit about the subprime lending. It wasn't then the crisis, but the subprime lending, and it just seemed like a scenario for disaster. Now that happened. It sort of happened sooner than what I thought. But ever since then, we've bought a few shares. We've bought some listed property trusts, but largely we've simply held cash. Pending a bit of confidence that the problems, particularly were in terms of governmental indebtedness, and how that might play out. We're really just holding cash until that does play out, and looks like it's been resolved.
Okay. In the meantime, people who are looking to just get out of debt, clear the decks, maybe look at getting back in a few years' time.
It's a great time to clear debt because interest rates are so low. So I would be saying to people, make sure that you use this time to cut the mortgage as far as you possibly can, because when interest rates start to rise, and it's a when, it's not enough, then cutting down your debt is going to be much more difficult. Now is a great time, assuming you've still got your income, still got your job, and so on, to use your income to reduce debt as fast as you possibly can.
Okay, so a good time to bunker down with a good book at night. Martin Hawes, The Money Map, latest book at number 20 for you.
That was well done.
Thanks, Martin, for joining us. My name's Amanda Morrell. I'm with interest.co.nz, and this has been another one of our double shot interviews.